Welcome to the Deep Dive. Today we're digging into Vertex Pharmaceuticals, ticker VRTX. They just dropped their third quarter 2025 earnings after market close.
Yep.
And our mission, as always, is to cut through the noise, figure out what management's really thinking, and crucially, why a company reporting great numbers saw its stock, well, stumble afterwards.
Right, that's the puzzle, isn't it? Because you had this backdrop, the biotech sector, the IDB index, doing really well lately, up almost 20% in 3 months. But VRTX, it was already lagging, down, over 18% year to date before the call.
Ouch.
Yeah, and that was because the market was already spooked by earlier pipeline issues like that VX-993 halt and just the sheer amount they're spending. So people wanted proof the new stuff was working.
Okay, so let's hit those headline numbers first because they really set up this contradiction. It was a clear double beat.
Absolutely.
Non-GAAP EPS, $4.80. Consensus was like $4.57. So a really solid beat there.
Crushed it.
And revenue came in at $3.08 billion. That's up 11% year over year, and also just nudged past what the street expected.
So clean numbers, good growth, great earnings beat.
Exactly. So then you see the stock dip, maybe 4% in after hours. How does that compute? Is the market just punishing good results now? Or is it really about the spending?
I think it tells you everything. The market isn't really treating VRTX on today's financials anymore. It's all about the future, specifically the execution risk outside of their core, cystic fibrosis, the story, the qualitative stuff, the cost of that future growth. It just completely swamped the good quarterly numbers. When you trade at a premium valuation like VRTX, investors expect near perfection down the road.
And they found some cracks in that story.
They think they did.
Yeah, okay, let's unpack that. Starting with the foundation, Cystic Fibrosis, CF. That business is still a powerhouse, right?
Oh, absolutely. The core engine is humming. U.S. revenue grew 15% year over year. Still strong patient demand, good pricing.
And Alyftrek, the once-daily drug.
That's a huge part of it. It's really ramping up. Must be close to $500 million in sales since it launched late last year.
Oh.
And what's really interesting is even within CF, they're still innovating. They highlighted data from the study in really young kids, 1 to 2 years old, showing nearly 70% of them got down to normal sweat chloride levels. I mean, that's an incredible result. Really shows the CF franchise itself still has legs.
Okay, so CF is generating massive cash flow. But that cash isn't going back to shareholders, is it? It's being reinvested aggressively.
That's the rub. That's where the market nervousness comes in. It's being plowed right back into these newer non-CF areas, and the spending is picking up pace.
Let's talk OPEX, operational expenditure. Combined non-GAAP R&D, acquired IP R&D, SG&A. It jumped 19% year on year to $1.28 billion in the quarter.
That 19% jump, that's the number that catches everyone's eye. And that acquired IP R&D, in-process R&D that's important, it tells you this isn't just organic growth and spend.
Right, it includes costs from companies they bought, like Alpine.
Exactly. That Alpine acquisition definitely juiced that quarterly spend number. And looking forward, management basically confirmed this trend. They raised the full-year non-GAAP OPEX guidance, tightened it upwards, actually, to $5.1 billion.
So they're doubling down on the spending, no apologies.
No apologies. They're signaling this is intentional, it's accelerating, this is the strategy.
They did throw a bit of a sweetener in on the tax line, though, a lower effective tax rate. Is that sustainable or just a way to make the earnings look better this year?
That's a fair question. They cut the full year non-GAAP effective tax rate guidance pretty significantly, down to 17-18%.
Why?
They said it was mainly due to one-time benefits, specifically R&D tax credits tied to that Alpine deal. So yes, it helps the bottom line this year, makes the profit margin look a bit healthier while they spend big elsewhere.
But you can't count on that every year.
No, you can't. It's more of a financial management tool for now, not a fundamental operational saving.
Okay, let's pivot to where that money's going. The new growth areas, pain, gene editing, renal. These have to work to justify that spending level.
They absolutely do.
Starting with pain. Gernivex, the non-opioid acute pain drug. Commercially, it seems to be doing well.
The commercial side looks quite good, actually. They hit some key access milestones, 170 million people covered, and crucially, 113 million have unrestricted access. No prior auth hoops to jump through.
That's huge for uptake.
It is, and the prescription volume reflects that. It went from, 10,000 in Q1 to 170,000 in Q3. That's almost vertical acceleration.
Okay, that sounds great. But there's always a but, isn't there?
There often is in biotech.
The pipeline news wasn't so hot. The follower-on pain drug, VX-993, got halted after a trial miss. That must have hurt.
Big time. That's the first major crack the market pointed to. It forces a reset on expectations for the whole pain franchise beyond Gernivex.
The great commercial execution on one drug.
Immediately undercut by an R&D setback on the next one.
Yeah.
It creates that narrative tension. You know, VRTX is brilliant in CF. Everything they touch there works. But can they replicate that success outside their comfort zone?
That VX993 miss raises the question, makes the other pain assets even more critical now.
Precisely. The pressure is on.
Okay, next pillar. Gene editing. CASGEVY. Amazing science. Potential cure for sickle cell and beta thalassemia. But the launch seems complex.
It's definitely a slow burn, but that's almost by design. This isn't popping a pill. It's a highly complex, one-time procedure.
Specialized centers, logistics.
Right. Cell collection, shipping, the treatment itself. It's more about activating a sophisticated medical process than a typical drug launch, but they are making progress.
What did they say about revenue?
They now expect over $100 million for the full year 2025. And the patient funnel is building nearly 300 referrals, over 160 cell collections started.
That does sound like momentum.
And getting reimbursement locked down in Italy for both indications is a big deal, too. Italy has a large population needing these therapies.
Okay, finally, the area getting perhaps the most attention, and maybe the most investment. Renal diseases, kidney diseases. Specifically, POVI for IgA nephropathy.
Yeah, this seems to be the big bet. Management is framing POVI as a pipeline in a product.
Meaning
they think it could be huge. It works differently targeting two cytokines, APRIL and BF. That dual inhibition might give better results. Plus, they keep emphasizing how patient-friendly it is.
the delivery method.
Yeah, a monthly subcutaneous shot under the skin with an auto-injector and a really small volume, less than 0.5 milliliter. In chronic diseases, convenience and ease of use are massive factors for success.
And they seem incredibly confident in the data, pushing it forward very fast.
Extremely confident. Look at the regulatory signals. FDA gave it breakthrough therapy status and rolling review for the BLA, the main application.
Okay, that's good.
But here's the kicker, the thing the market might be underappreciating. They confirmed they used a priority review voucher, a PRV.
Remind me, what does that do?
It guarantees an expedited FDA review, 6 months, instead of the standard 10. But these vouchers are expensive. They can trade for up to $100 million.
So Vertex basically paid potentially 9 figures just to speed up the FDA decision by 4 months?
Exactly. That's management putting serious money where their mouth is. They believe POVI is a winner, and they want it on the market ASAP. It screams confidence.
And they enrolled the phase 3 trial quickly, too.
Record time, basically. Fastest contemporary phase 3 in IgAN. Got 600 patients in about 15 months. Speed is clearly the name of the game for POVI.
Okay, so pulling it all together, we've got the profitable CF engine funding this big push into renal with POI, where they're showing huge confidence.
Right.
But we also have the rising OPEX, the pain pipeline setback with VX993, and the gradual ramp for CSPAC. It feels like a real divergence.
It's a classic story, really. Management is playing the long game. They see CF funding the transition to a multi-engine growth company, renal, pain, gene editing.
But the market?
The market, or at least the traders reacting immediately, they're focused on the cost of that transition today. That 19% OPEX jump looks scary when the proof points for the new engines are still emerging, or, in the case of VX993, hitting bumps.
So VRTX is still CF plus some potentially expensive options in the market's eyes?
For now, yes. They need those options, especially POVI, to start delivering clear, significant non-CF revenue to change that perception.
Which makes the near-term catalysts absolutely critical.
Couldn't agree more. Activating more CSGEVY centers matters. Getting that third big PBM contract for Gernivex would help the pain story.
But the big one is POVI, right?
Absolutely. The data readouts coming up, especially at the ASN Kidney Conference, and then the actual BLA filing using that speedy review path, those are the events that could really shift the narrative.
All right. Let's shift gears to the most speculative part of our deep dive, the not financial advice segment. If we're pitching an idea based purely on this call, what's the outrageous but plausible trade?
Okay, playing analyst here, strictly hypothetical. My thesis would be the market overreacted to the OPEX and the pain setback, and it seriously underestimated the signal sent by using that expensive priority review voucher for POV.
Meaning they didn't grasp the speed and confidence behind POV.
Exactly. And crucially, the company itself is buying back stock heavily, $1 billion just in Q3. They're using this dip, this volatility, as a buying opportunity.
So they're creating a floor, maybe?
Potentially providing some support, yeah. So the trade idea leverages that disconnect and management's own actions.
How would you structure it?
I'd pitch a long-dated, out-of-the-money call spread. Think maybe Q3 2026 expiry. It's a defined risk bet.
Why that structure?
It's a leverage play specifically on the POV inflection point happening faster than the market thinks, thanks to that PRV. If POV data lands well and the BLA gets filed and approved quickly within that 6-month window.
The stock could re-rate significantly as a multi-engine company.
That's the idea. It snaps back. You're essentially betting alongside management's 9-figure PRV gamble, using the current depressed price as your entry point for that longer-term potential.
Interesting. Okay, wrapping up our deep dive then. Vertex delivered the financial goods this quarter, beating on top and bottom lines. No question there.
Clean beat.
But the market conversation has completely moved on. It's all about execution in the new areas, renal, gene editing, pain, and whether they can justify this major ramp-up in spending.
Management confirmed the spending is accelerating. Now they absolutely have to deliver the blockbuster results outside of CF to make it pay off, especially after that VX993 stumble in pain.
Which leaves you, the listener, with final thought to chew on.
Yeah, consider this. Vertex just spent maybe $100 million just to speed up the review for POVI. Does that level of conviction mean the market is being way too pessimistic about how quickly they can diversify?
Or is the VX993 failure a warning sign? A sign that translating that incredible CFR&D skill into other very different disease areas is going to be much harder and perhaps costlier than expected.
That's the multi-billion-dollar question hanging over VRTX right now. Finding that answer will likely define the stock's path for the next few years.
Indeed it will. Thanks for joining us for this deep dive on Vert.x Pharmaceuticals. As always, this was for informational and entertainment purposes only, definitely not financial advice. We'll catch you on the next one.